Today, on October 4th, 2025, we stand at a pivotal moment for Pakistan's public sector financial management. A new standard, International Public Sector Accounting, Standard 40, Ipsas 40, will bring unprecedented clarity and accountability. It improves transparency when government departments merge or take control of other entities. For every public sector worker, accountants in Islamabad, administrators in Karachi, understanding Ipsas 40 is crucial. It is a major step toward modernizing public finance and ensuring every rupee is accounted for with precision and integrity. The importance of Ipsas 40 for Pakistan cannot be overstated. Our public sector is vast and complex, often involving restructuring, creation of new authorities, or merging provincial departments. In the past, accounting for these changes was inconsistent, obscuring the true financial picture. Ipsas 40 provides a single, uniform framework for such combinations. When entities combine, it ensures financial statements tell a true and fair story. This helps policymakers, auditors, and the public understand the real financial impact and fosters trust. At its heart, Ipsas 40 is a rulebook for public sector combinations. A combination is when separate public operations are brought together under one reporting entity. Think of it like two streams becoming one river. An operation is a set of activities and assets managed to provide public services. The standard applies across Pakistan, federal, provincial, and local. Purchasing a group of assets, like new buses, is not a combination. Internal reorganizations without changing the reporting entity are excluded. Ipsas 40 is triggered when distinct operations come under a single entity's control. Example: if PWD takes over a provincial roads agency's operations, Ipsas 40 applies. But a simple budget transfer to hire staff is routine, not a combination. Ipsas 40 divides combinations into acquisitions and amalgamations. Acquisition: one entity gains control over another. Amalgamation: no single acquirer. A merger of equals. In the public sector, control is established by law, cabinet decisions, or ministerial orders. If a federal ministry is given power over a provincial authority, that's an acquisition. If two municipal committees form a new metropolitan corporation, that's an amalgamation. Decision test: can you identify an acquirer? If yes, acquisition. If no, amalgamation. This choice sets the accounting path. When a combination is an acquisition, Ipsas 40 requires the acquisition method. Step 1. Identify the acquirer, the entity that gains control, often by decree or law. Example: NHA directed to take over a toll road authority. NHA is the acquirer. Step 2. Determine the acquisition date. The date control is obtained. Step 3. Recognize and measure identifiable assets and liabilities at fair value. Buildings, vehicles, specialized equipment, cash, and liabilities like loans and payables. Fair value: the price to sell an asset or transfer a liability in an orderly transaction. Use market values for property. Engage valuers for specialized assets where needed. Step 4. Calculate net assets and recognize the difference in net assets or equity impact. Often no consideration is paid. If net assets acquired are PKR 500 million, equity increases accordingly. Disclose clearly how the acquisition changed the financial position. When there is no acquirer, use the amalgamation method, a merger of equals. Guiding principle: continuity. We do not revalue everything to fair value. Assets and liabilities are brought in at existing carrying amounts. If a building was PKR 10 million, it remains PKR 10 million in the new books. Combine net assets and equity. No gain or loss is recognized. Disclose the entities involved, the effective date, and confirm the amalgamation method in opening statements. Pakistan example: PPIB operations are absorbed into AEDB to streamline energy projects. AEDB retains identity and gains control. This classifies as an acquisition. The notification date is the acquisition date. AEDB applies the acquisition method. Identify PPIB's assets and liabilities and measure them at fair value. Recognize on AEDB's balance sheet and disclose the equity impact. Seamed example: KWNSB and SSWMB form Karachi Utility Corporation. No acquirer. So amalgamation. Combine book values into an opening balance sheet. Disclose names, date, and method. Use decision trees to classify. If an acquirer is identifiable, acquisition; if not, amalgamation. A 4-step timeline clarifies the acquisition method. A before and after diagram shows pooling without revaluation. A comparative table summarizes valuation basis, recognition, and equity treatment. Challenges include low familiarity with accruals, fair value, and classification. Prioritize practical, case-based training across departments. Build valuation capacity, and consider a central panel of approved valuers. Modernize asset registers and adopt robust accrual systems. AGP and PIFA should lead standardized modules, guides, and help desks. Benefits: clearer statements, better decisions, accountable governance, and public trust. Alignment with international best practices enhances credibility, ratings, and financing.